Unity stock down around 90% this past year. And if you checked out my prior videos on Unity, this wouldn't have come as a surprise. I said, look, there's some exceptional products here. There's exceptional aspects to Unity, but the valuation was too frothy. I said there was a lot of downside potential. And that unfortunately, investors are waking up to the reality that what's the difference between an 80% drop and a 90% drop? Another 50%. And that's what investors have experienced. And now you're looking at third quarter results, stock down another 10% today, plus 5%, between 5 and 10% after hours following their third quarter results. So how bad was it? Is this potentially the bottom for Unity? Where do I think Unity stock goes from here? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. So let's understand what's going on with Unity. So looking at broadly very mixed results, revenue increased about 13%, not great, but still looking at sizable losses, both in non-GAAP losses of nearly 40 million. That adds back stock-based compensation, as well as real free cash burn. So you're looking at cash burn of around 80 million in the quarter. Folks, I mean, this is where management needs to wake up. You know, not everyone's Amazon. If you're posting 13% growth, only 13% growth, you need to be posting positive free cash flow. And that's where management is waking up and sort of saying, oh, we'll get to free cash flow. And they're expecting, to get there maybe at the end of this year and directionally head there. So this is the critical aspect for valuing businesses, where if you keep cash burning, Wall Street's just going to keep whooping on you. And you need to get to a point of saying, hey, we are going to be free cash flow positive and meaningfully free cash flow positive to justify multi-billion-dollar valuations. Okay, so let's understand, well, let's peel it back a little bit. So there were two aspects, really two main segments. They have three. The third, strategic partnership and other revenue, it's very small relative to the others. So you have Create Solutions, which was up 54%, and you have Operate Solutions, which decreased 7%. And so when you think about these two components, Create Solutions is the critical licensing and software for incredible, stunning visual, virtual effects, whether or not it's 2D, 3D in games, in, let's say, industrial design. They have a very strong engine here that they're marketing, effectively saying, hey, if the future is incredibly immersive entertainment, we are going to be one of the engines that powers that. And that 54% growth suggests it's doing really well. The problem is, it's 128 million in revenue versus their Operate business, which arguably is a very different business, which is tied to helping games monetize, helping game creators effectively have a sustainable game. Create Solutions up 54%. What I don't like, and I need to call out, and this is super important because I wasn't able to get the clarity on this, is that earlier this past year, I think at the end of last year, last 12 months, give or take, management acquired Weta Digital for something like $1.6 billion, which arguably is helping their Create Solutions. So that 54%, how much of that is organic growth? How much of that comes through acquisitions? They didn't spell that out, and it's a mark against management. Arguably another mark against management, because that should be something that's spelled out if that's actually 54% organic growth or how much actually came from their acquisition, because they just acquired Weta, this past year, a very sizable acquisition. And so looking at that, so you have Create Solutions, you have Operate Solutions, which declined 7%. So what's going on there? We'll talk about that in a second. And then you see this sort of wet noodle chart. This is not what you want to see. You want to see up and to the right when you're looking at companies. This is dollar-based net expansion. So effectively how much customers are spending, the existing cohort base, existing customers are spending effectively 11% more year over year. So any sort of that delta between 13% and 11%, that's new customers. So overall, their existing customer base spent 11% more year over year, which is down significantly from the 140% dollar-based net expansion rate previously a few quarters ago. So what's going on there? Well, that all comes down to their Operate segment, which once again is all about helping games monetize, where they get paid when a game is able to, get a new install based on the advertisements that Unity helped, put and, gets placed and that gets bid on and the, user clicks on it. And this was partly because self-inflicted wounds, I'd say, where they had some data quality issues in the prior quarters. And, they say, hey, we're making some progress here. So it's not only the problem that advertisers and the games weren't actually getting the results that they expected. So they had some prior data quality issues. But now you're seeing the problem that there's recession. That's the concern, saying, hey, we look at the overall in-game ads market growing 10% in the second quarter, slowed to single digits in the third quarter, which is weird because it was actually, they actually declined 7%. But anywho, and then they're saying, yeah, but we're expecting this overall in-game ads market to be flat year on year in the fourth quarter. So saying, hey, we're looking at recessionary impulses. The cost per impressions have declined on both mobile operating systems, and the advertisers they're talking with, they're getting clearly, one of caution. That's the sense, and reticence to commit to aggressive campaign spends that would crowd out competition and ultimately bid up cost per impression. So you're saying, look, advertisers are very sensitive. The market for ads is experiencing recessionary sentiment. So this is not only self-inflicted wounds, but looking at a broader cyclical slowdown. This is arguably something I've been calling out once again for months and quarters now, saying, hey, the monetary tightening that you've seen from the Federal Reserve, it takes time for that to play out through the economy. And you're just starting to see the impact now. You're just starting to see the impact on the results. Now, you haven't seen the full impact. The full impact is when it's like, oh my gosh, these are terrible results. This is still reasonable. They're just starting to see it, and that's what they're calling out. They even called it out, saying the declines take place as the world's banks increased interest rates, and the specter of recession was everywhere in the press. So it just starting to play out. This recession for gaming, for advertising spend within games, can't come at a worse time for them because they just completed a merger, literally, like I think Monday this week, with ironSource, an all-stock deal for $4.4 billion. So they just made a big bet on ironSource, which is a bid to, effectively a consolidation play for gaming, paying something of arguably a rich multiple, around 20 times EBITDA for this business. And it comes at a time when the economy is slowing down. Now, management would say, well, wait a second, this ironSource deal, it's great because, it helps us give this ad supply and demand auction engine. They're saying, hey, this is a tool that we needed to help connect, ad supply and ad demand. This will, by having more suppliers effectively on this ad network, and having, more advertisers, more ad buyers, it becomes a richer network. It becomes, ultimately fuels, greater growth for Unity in the future when you have a richer network of, let's say, publishers as well as advertisers. And so they're saying, well, this was actually still a worthwhile acquisition, even though we're starting to face a recession. So the question is, well, what happens to Unity stock from here? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. And so looking at Unity, thinking about where does it go in the future, there's a couple of different data points to consider. One is management saying, yeah, we think we're going to be able to grow 30% sustainably in the years ahead. I'm always cautious about that. I think there's a huge opportunity for them. I think Create Solutions, talking about incredible VFX is just, there's a long runway ahead of them. Talking about 30% year growth, we'll see. I have memories of Palantir where Alex Karp said 30%, 30%, 30%. Now they're growing 22%, and he's at Palantir. So I'm very cautious about management saying that. I'd rather them underpromise and overdeliver. And it's almost like they're immediately overpromising and underdelivering because they're like, oh yeah, and by the way, this 30% growth, this won't be the case every single year. So let's caveat this. Like next year, probably not. They'll say, okay, well, we'll give you our guidance for 2023 when we have a better view on the economy, particularly what's going on with in-games ad spends and sort of seeing what's going to happen there. But broadly, over a multi-year perspective, we're still thinking 30%, but maybe not next year. That's effectively what they're saying. Now, you still have this deal with ironSource, where effectively, maybe this company, and this is part of the reason why management talked about it, is saying, hey, we did this great deal, and even though I think it's expensive, they're like, yeah, there's going to be $300 million of synergies, and within a few years, we're going to be at $1 billion in EBITDA versus significantly unprofitable now. I mean, if you're talking $1 billion in EBITDA, who knows how much stock-based compensation? I mean, at this point, I'm not giving a lot of credit to management in all honesty, just given some of the missteps here. So maybe $1 billion in EBITDA, maybe you're talking about 500 million in free cash flow, excluding stock-based compensation. And thinking about the valuation for Unity, here it is. Previously, AppLovin bid $20 billion for it now in a stock deal. So seeing the stock now at $10 billion, it's kind of an interesting data point. And so, okay, so how do we put all these pieces together when we're thinking about Unity and where it goes from here? So now the stock's around $20. It's around a $10 billion valuation. There's some additional dilution that happens closer to $50 a share based on some convertible debt that they issued. And so I'm looking at this and I'm thinking, well, management's guiding to around 1.3, 1.4 billion in revenue this year, which includes their most recent acquisition. What's the margins longer term? Clearly they're unprofitable now. So this is, I'm making an assumption that they're able to get to around 25% in the future. That's a guesstimate. We'll see what they're able to deliver, and honestly, by assuming 25%, that gives management a lot of credit, in my opinion. Let's see them actually deliver. And I'm not giving management credit to the full 30% that they're targeting, partly because I think that 30% is going to be diluted per year. And I don't think they're going to hit it. I don't want to come across as super cynical on this, but based on some of the blunders that have happened so far and based on bidding, 20 times EBITDA for this ad company right before you have an ad recession, and clearly, data problems that were once again self-inflicted, I look at this and I'm thinking it wouldn't surprise me if management gets the boot within a few years because they don't hit that $1 billion EBITDA figure. That would, if I had to bet on the outcome here, that would be my central base case. Because especially when you consider that most acquisitions actually don't play out. Most acquisitions, something like 80% of acquisitions don't deliver the way management expects. And so I look at this and I'm thinking, based on the track record here, I'd absolutely love to think they do better. But let's see. At this point, it's a show me story for sure. Like I would love to be eating humble pie where they're delivering $2 billion in EBITDA by 2025. Like let's revisit that. Now, thinking about where the stock goes, if they're able to deliver on, let's say, low 20% growth, which is still quite attractive, and that's on effectively a diluted per share basis. That's how I'm thinking about it. And they're able to get valued on 25% profit margins. So generating around, $1 billion in operating profit 5 years out. So, that $1 billion in EBITDA that they're targeting by 2025, maybe it's closer to 2027. That's sort of what I'm saying here. Slap on, a 20% tax rate, assume maybe, low 20s multiple. I'm giving them a higher multiple than I would have, partly because I think their Create business is so strong, but their ad business clearly needs to get ironed out and prove itself, in my opinion. They got to make sure they iron out some of the problems. And so I'm looking at this and I'm thinking it's certainly better than what it previously was. I'm sort of thinking over the next 5 years, it wouldn't surprise me. And keep in mind, this is a hypothetical framework. Of course, stock price can go way higher, way lower. It's going to depend on management's execution, which at this point, they really need to do a lot of, they need to do a lot of execution. They need to prove themselves at this point. Like that's what I'm looking at here. And so I'm looking at this and I'm thinking over the next 5 years, it wouldn't surprise me to see the stock flat. It wouldn't surprise me to see the stock up maybe 150% from here. That's sort of the range. Now that's better than what I previously looked at, where I previously said, I just don't see it. So it's definitely getting more interesting. And, look, when you previously had a bidder, for $20 billion, so could you wake up and find a bid? So that's, where it's up 50%. That's definitely possible here. Because their Create Solutions is such a valuable business segment. I mean, I wonder if you'd actually create more value if they split up the business. I mean, that I'd argue if you get an activist involved saying, hey, you need to split up this business, then it would actually could get quite interesting. In a year or two, I'd argue if Create continues to grow at this pace, which is possible, it's going to be tougher with the recession. You could argue the Create segment within a few years could be worth the entire market cap. But that we'll see. I mean, that's going to require extreme, continued exceptional execution. And once again, it's hard to tell like how much of that growth this year, this 54% that they're calling out, how much of that is organic versus their acquisition of Weta earlier or other acquisitions. And so I think, I'm thinking flat to up 150%. It's hard to imagine, honestly, outside of some acquirer getting nutty. It's hard to imagine a scenario much more than, let's say, 150% at this point, because their deal that they just closed was in stock. This $4.4 billion deal was in stock. And I'm thinking that's a lot of shares, and there's a convertible note that goes with it that effectively exercises at $48 a share. And so if you get that 150% upside, then you have a lot more dilution come on. So I'm thinking like it is harder. That I'm thinking it's sort of range bound from here. You might get downside just with the economy, but over a 5-year perspective, I would expect either flat to 150% upside. That's how I'm thinking about how it can play out. We'll see ultimately. Like if they don't execute, it'll be way lower than that. And management once again needs to execute. I would love to own their Create business. I'm less excited about sort of their enabling games business because it hasn't delivered. But I'd very much like to see, because you really only have a few engines here that are powering this, and it's incredibly powerful, and it's really neat stuff. I mean, you're talking about 3D visualization, digital twins. I think that is the future. But the question is like, hey, could you split that off and get a good deal on that? So we'll see how this plays out. I personally think, looking at Unity, it wouldn't surprise me if it's range bound from here. Maybe it goes lower with a further worsening of the ad market. I'm not a buyer at this point, just because I think management needs to prove themselves, and they've just done serious missteps along the way. And if they don't start getting close to that $1 billion in EBITDA, within the next few years, then I would expect that they'd be out. Just based on you can't do this huge acquisition and issue a ton of stock. Fortunately, the stock that they issued expensive stock, at least. But still, this is a show me story. Let's see them execute. So if you enjoyed this video on Unity stock, and if you have any thoughts below, if you're a mega bull or mega bear, feel free to leave comments, in below this video. And if you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for watching Unrivaled Investing.